I recently did a new video format in which I looked at 10 REITs and rated them from highest quality to lowest quality. I got a ton of great feedback from you guys requesting more similar videos. So today we are going to look at 5 Dividend Kings doing the same exact thing, ranking them from highest quality down to lowest quality. Quality and valuation are two different things. So although the ranking system is based solely on quality, we will also take a quick look at valuation to determine how the stocks are trading right now, if they're trading at a reasonable valuation, if they look overpriced, or if they just look flat out cheap. So here's a look at the 5 Dividend Kings that we're going to look at today. And remember, to be a Dividend King, you must be a dividend paying stock that has increased your dividend for 50 consecutive years and counting. So those 5 Dividend Kings include Lowe's Companies, stock ticker LOW, 3M, stock ticker MMM, Johnson & Johnson, stock ticker J&J, Altria Group, stock ticker MO, and PepsiCo, stock ticker PEP. Now that we know the 5 Dividend Kings that we're going to look at, do me a huge favor as it really helps out the growth of this channel, and click that like button down below. Subscribe to the channel so you'll be notified anytime we drop new videos or go live. Every Thursday we do the Dividend Power Hour, which is a Q&A session, and I also update you on some important economic activities that are going on throughout the week. With that being said, let's jump into the video. Hey everyone, Mark Rusin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me take a quick moment to thank today's video sponsor, which is The Motley Fool. The Motley Fool has a ton of great resources and tools available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy right now. Definitely something to check out, but now let's get back to our video where we're going to rank these 5 Dividend Kings, beginning with Lowe's Companies, stock ticker LOW. As many of you know, Lowe's Companies operates within the home improvement sector, operating in a duopoly with the likes of Home Depot. Lowe's has a market cap of $126 billion, and over the past 12 months, shares are up 26%, and year to date, they are up 8%. Lowe's has done a great job closing the gap between themselves and Home Depot under the leadership of Marvin Ellison, who back in the day happened to be a senior leader over at none other than Home Depot. He has made tons of great improvements that really impact efficiency, changing the storefront technology, changing the store layout, the number of SKUs, and focusing on high margin products. Again, everything has been focused on becoming more efficient, increasing margins, and all of this is really beginning to show. After all, in the latest quarter, Lowe's actually outperformed the likes of Home Depot, which is really not something that we have been accustomed to over the past decade. They've really been the little brother in this home improvement sector. Lowe's is a premier dividend stock, having increased their dividend for 62 consecutive years and counting. And really, once you become a Dividend King and get to that level, you see the dividend growth really stagnate out, and it's not all that much. But Lowe's has bucked that trend. They're actually a dividend growth stock and a Dividend King, not something you see all that often. Lowe's currently yields a dividend of 2.1%, offering a good mix of share price appreciation and dividend growth, as they have a 5-year dividend growth rate of 18%. In terms of valuation, analysts are looking for 2023 EPS of $13.35 per share, which equates to an earnings multiple of 16.1 times, which looks intriguing given they have a 5-year average multiple of 19.2 times and a 10-year average multiple of 20 times. So where do we rank Lowe's in terms of quality? Under the new leadership of Marvin Ellison, who's only been at the CEO helm for just a couple of years now, we are seeing night and day between the old leadership and new leadership. After all, he came from Home Depot, so he knows exactly what makes that company tick, and he is putting his fingerprints all over this company. They are a great dividend company, generating strong amounts of free cash flow. They have a triple B+ rated credit rating. As such, I rate Lowe's, in terms of quality, in the must-own category. After all, they operate in a duopoly with the likes of Home Depot, and they're rather immune to the threats of e-commerce. The second Dividend King that we're going to look at today is 3M, stock ticker MMM. This is a company that has a tremendous portfolio, but they have been a company under turmoil with the amount of lawsuits they have been undertaking. It has the company teetering on the brink. 3M currently has a market cap of $56 billion. Over the past 12 months, shares are down 21%. And year to date, it's not that much better, as shares are down 16.5%. 3M has a very diversified product base, and they have played a major role in the U.S. economy over the years. However, over the past few years, the company has faced an onslaught of lawsuits, all related to these earplugs that they sold to military personnel that has resulted allegedly in hearing loss. There are now over 230,000 lawsuits related to this single product. The legal proceedings continue to play out through the courts, with no real news to update you on that is either good or bad for the company. But one thing I do know, as these legal proceedings have really weighed on the market cap of the company over the past few years. Looking at this chart here, you can see the company's fall from grace, reaching a peak market cap of nearly $160 billion in 2018 to now having a market cap of just $56 billion. This chart is the definition of a falling knife. Nonetheless, the company is a dividend king, as they have paid a growing dividend for 65 consecutive years. That is a very impressive streak nonetheless. However, the quality of the increases are more of an administrative move. As you can see here, the company has a 5-year dividend growth rate of only 2%, and the past 3 years have all included dividend hikes of less than 1%. 3M currently has a high dividend yield of 6.1%, which is more a result of the falling stock price we have seen. Now looking at valuation, where analysts are expecting 2023 EPS of $8.64 per share, which would be a 14% decline from the prior year. This EPS equates to an earnings multiple of 11.8 times. Over the past 5 years, for comparable purposes, shares of 3M have traded at an average multiple of 18.8 times, and over the past decade, closer to 20 times. So if you are someone that likes higher risk, this may be another company to look at, because if those legal proceedings can get set aside and the company can go back to focusing on their very diversified portfolio, then 3M could be in good shape. However, these legal proceedings are really weighing on the company. They've been much of a black eye. So in terms of quality rating, I'm going to rate this a prefer not to own stock right now. Dividend King number 3 is Altria Group, stock ticker MO. Moving from one high-yield dividend stock to another, this is the second largest tobacco company in the world. Altria Group currently has a market cap of $78 billion. Over the past 12 months, shares are down 5%, which is in line with their year-to-date results as well. The company can be somewhat controversial for some investors that don't want to invest in companies that make or sell certain products such as tobacco or alcohol or any of these other sin-related stocks. But really, when it comes down to it, for me at least, you could really poke a hole in many different businesses out there today. For years, Altria has really been known as a cigarette producer, or manufacturer, I should say. But over the past few years, management has done a nice job diversifying the company's portfolio over to e-cigs or smokeless tobacco, among various other products as well. After all, the company's slogan right now is moving beyond smoking. And over the years, as it's well documented, cigarette shipment volumes have been in constant declines. But even with that, revenues have held up due to the company's very strong pricing power. The decline in cigarette volumes seem to be picking up steam, as younger generations aren't all that interested in cigarettes, as they're a little bit more focused on health. So this does not bode well for the company's foreseeable future. Again, with that, there's also rising taxes and talks of bans in certain states or different areas. However, Altria has been able to generate strong free cash flow over the years, and that has turned into an aggressive share repurchasing policy. As you can see here, the shares outstanding have fallen from more than $2 billion in 2013 to roughly $1.75 billion in 2023. The company has paid a growing dividend for 53 consecutive years, and they have a 5-year dividend growth rate of 7.3%. The stock currently yields a very high dividend yield of 8.4%, which is getting tighter and tighter in terms of payout ratio. Looking at valuation, shares of Altria currently trade at an earnings multiple of just 8.7 times compared to their 5-year average of 10.5 times and their 10-year average of 15 times, which I believe those multiples are long gone. In terms of rating, I don't really see a huge path forward in terms of growth. Although the company does pay a very high dividend yield, if the stock isn't doing all that much, well then that dividend doesn't make sense, especially if the stock price is falling. As such, I'm going to put Altria in that like but don't love category. Dividend King number 4 is PepsiCo, stock ticker PEP. As many of you know, PepsiCo is one of the largest beverage and snack companies, trailing only Coca-Cola when it comes to beverage in the world. The company has a market cap of $255 billion, and over the past 12 months, shares of PEP are up 15%, but year to date, the stock has not done that much as it's up only 3%. I go back and forth between, do I want to own Coca-Cola, that's just beverage, but they dominate the beverage business, or do I want PepsiCo, who also gives you that snack component? In full disclosure, I do own Coca-Cola, but I do like the component of the snack side that PepsiCo offers. And the snack is what is so intriguing to many investors out there, although the margins aren't all that great. Coca-Cola dominates when it comes to operating in free cash flow margins compared to PepsiCo, and much of that has to do with their snack segment. But this is a similar story to what I've seen with Lowe's. They've had a huge gap to close between them and Home Depot, but that also provides a ton of opportunity. I see that same thing with PepsiCo here and Coca-Cola, providing great opportunity moving forward. In terms of dividend and Dividend King status, PepsiCo is the newest Dividend King on this list today, as just last year, they became a Dividend King with their 50th consecutive years of dividend growth. Like I mentioned earlier, when companies actually become Dividend Kings and reach this mature status, you don't see all that much in terms of dividend growth. We saw very little, almost none from 3M. Lowe's really bucked that trend, but PepsiCo gives you a little bit of growth here with a 6.4% 5-year dividend growth rate. However, the past 2 years have beaten that average, and just recently, PepsiCo increased their dividend by 10%. So there's some things to be excited about if you are a PepsiCo investor. And in terms of the yield, the company currently yields a dividend of 2.7%. Now turning our attention to valuation, and analysts are looking for EPS of $7.29, which equates to an earnings multiple of 25 times. So not necessarily a cheap consumer staple stock by any means. Over the past 5 years, for comparable purposes, shares have traded at an average multiple of 26 times, and over the past decade, closer to 23 times. So I'd like to still see the stock come lower before even thinking about initiating a position. So in terms of quality, when it comes to PepsiCo, they are a great company. They have a strong balance sheet, strong management team. They do have some efficiency areas that they can improve, so there's things to be excited about there. They also have great products that are in demand all over the world. So for that reason, I'm going to rate PepsiCo as a high quality company. Now moving on to our final Dividend King, which is Johnson & Johnson, stock ticker J&J. All the Dividend Kings that we have looked at thus far are all well-known companies, but it would be hard to argue to say that Johnson & Johnson doesn't have products making them the most well-known. After all, their consumer health segment has labels such as Tylenol, Motrin, Zyrtec, Aveeno, Neutrogena, Listerine, among a slew of other products. However, they just recently rolled or spun off their consumer health segment into a brand new public company called Kenvue, trading under the stock ticker KVUE. So no longer do they have this consumer health segment. Now the new Johnson & Johnson, if you want to call it that, has a pharmaceutical segment as well as their medical device segment, also known as MedTech. Johnson & Johnson currently has a market cap of $427 billion, and over the past 12 months, the stock has been stuck in the mud as they are down 5%, and year-to-date, shares of J&J are down 8%. Similar to 3M, J&J also has a bunch of legal proceedings hanging over their head. Not quite to the extent of 3M, but they are large nonetheless, but it seems like things may be coming to an agreement here in the very near future. Looking at the business, Johnson & Johnson has a very strong pharmaceutical segment with a strong pipeline. This has actually been the largest segment of Johnson & Johnson for a number of years. And in terms of the MedTech segment, as surgeries and normal procedures come back to fruition after really slowing down and just coming to a complete halt during the pandemic, this should definitely help sales growth in that segment moving forward as well. Johnson & Johnson is another company that has really shown their ability to generate strong amounts of free cash flow. And what this has done has led to consistent dividend increases as well as share buybacks. Looking here, you can see how shares outstanding have decreased for the company over the past decade from more than 2.8 billion shares outstanding to now having less than 2.6 billion, which is roughly an 8% decline during that period. In terms of the dividend, Johnson & Johnson has paid a dividend since 1944, and they have grown it consistently for 61 consecutive years. The dividend currently sits at 3% even, and they have a 5-year dividend growth rate of 5.7%. Looking here at valuation, analysts expect J&J to generate EPS of $10.65 per share, which equates to an earnings multiple of 15.4 times, which is slightly below the company's 5-year average of 17.2 times and their 10-year average of 17.3 times. In terms of the quality rating, Johnson & Johnson is one of the highest quality companies you will come across. After all, they have a AAA rated credit rating, higher than the US government, if that's saying anything. But I have really stuck with this company, and it is a top holding of mine. They have a strong management team, a very strong balance sheet. They have shown the ability to manage debt as well as continue to grow over a number of decades. Although they still have some legal issues to deal with, I still rate Johnson & Johnson as a must-own dividend stock. So that concludes our video in which we ranked 5 Dividend Kings. From our highest quality to our lowest quality. Our must-own stocks were both Lowe's and Johnson & Johnson. Our high-quality stock was PepsiCo, followed by our like but not love stock, which is Altria Group, and then our prefer not to own stock, which has a lot of legal issues right now and provides a little bit of risk but higher upside because it's trading at a great valuation. And if that's a type of stock you're looking for, then take a second look at 3M. But that's not a stock that I'm all that interested in right now. Down in the comments section below, let me know what your rating would be for these 5 Dividend Kings. Rank them from best quality to lowest quality. And if you haven't done so yet, hit that like button down below, as I truly appreciate it and it really helps the growth of this channel. And with that being said, we'll see you in the next video. Take care.